Hey, Stephen Kirkland, Zubar Cattle Company. I had a question a couple of days ago and asked people if they wanted to learn more about the CME cattle futures. So, those of you that like entertaining posts or stuff that's silly or stupid or entertainment, this post is not for you. This is 100% educational, and just keep on scrolling through there because more than likely it's super boring. But I really like it. I like trading futures. I enjoy watching the cattle market. It keeps me involved in it, and I learn a lot. I taught myself how to trade. I'm not an expert trader. I do small amounts, but I do pretty well in it, and it's kind of fun, especially fun when you're winning. When you're losing, it's not that much fun. But I wanted to kind of do a few videos, maybe do one video a week, two at the most, on trading cattle futures, what I know, and just kind of pass that along to you. So CME is the Chicago Mercantile Exchange. That's an exchange where you trade all your commodities: wheat, corn, oil, soybeans, cotton. There's tons of stuff that gets traded on there. I only concentrate on feeder cattle, which are basically you've got calves that come off of the cows, and then you've got stocker cattle, so say like from 5 to 800 pounds, and then you've got your feeder cattle, so cattle that are going to be right around that 800-pound mark that are getting ready to go in to the feed yard. That's going to be your feeder cattle. So you've got the feeder. What I trade is going to be your feeder cattle, your live cattle, and those are the cattle that are ready to come out of the feed yard that are finished, weighing like 1,400 pounds, and corn. Because a lot of times what guys will do is they will go ahead and they will sell their live cattle as part of a hedge, part of their contract. They'll sell their live cattle, but they forget to offset that by a purchase of corn. They don't lock in their expenses, and they really can lose a lot of money that way. And I can explain that trade later. But okay, so the CME cattle futures is based off an 800-pound steer delivered to the panhandle of Texas, and you've got basis from everything from there. So let's just say a 800-pound steer right now, an October contract is trading at $1.85 a pound. So $1.85 times 800 pounds, you kind of get about what that's worth on the futures contract. Well, that $1.85 a pound is not going to be the same value for a steer in Florida as it is a steer in New York or Washington or Nebraska. You're going to have freight involved in there. You're going to have cattle that are not as good of cattle in Florida in some instances. You're going to have cattle that have maybe got too much Brahman influence in them, or there's different factors. But the feeder cattle contract is based off of a steer delivered in Texas Panhandle, say like Lubbock or Paducah or Hereford. Most of them are Hereford, Amarillo area. So a $1 move in a feeder cattle contract is equal to $500 profit or loss. So if I'm going to use real numbers, so today I was trading the October feeder cattle contract, and I bought that contract the other day. I bought it last week. I think I bought it last Tuesday, I believe. So I bought that contract at $1.8180 was my buy. Well, they had some news come out today that the war in Ukraine may not be as bad, or their peace talks or something like that. Corn went limit down and cattle jumped up all of a sudden. Well, I saw that on my phone. I wasn't really watching it. I just happened to look down, and my contract jumped to 185. So I had a 181 buy, and it jumped to 185. I went ahead and I called my broker and I put in a sell order at 185, and the market, it hit my strike price at 185. Okay, a $1 move in feeder cattle is equivalent to $500. So in this instance, the difference was a $3.20 profit times 500. So that one trade made $1,600 in a week. And that's a pretty good trade. I'm very happy with that. I'm a base hit kind of person. I'm not looking for home runs All I'm doing in this type of market right now is I'm trading the volatility. I don't really care if it's at $1.40 or if it's at $2.40. I don't really care where it's at. All I'm doing is when it's in the red one day, I'm buying it. What's in the green, whenever that might be, I'm selling it. That's all I'm doing is just simply trading the volatility. Now, you've got to have the right temperament to be able to trade commodities, because they can go up really fast and they can come down really, really fast. And you've got to not only have the right temperament, but you've got to have enough liquidity and cash to back you up in those trades. So one contract, the margin is $2,500. So if I buy one feeder cattle contract, or if I sell one feeder cattle contract, then I have to, my broker will call and they'll say, we need a $2,500 margin call. That's my initial margin that I have to have in that account. Well, if the contract, let's just say, for example, let's just say it goes up $2. Well, that's a $1,000 move. If it goes up $2, I don't have to do anything about it. Now, if the market goes down $2, then that's $1,000. Then my broker's going to call, say, hey, we're on margin call for $1,000. So I've got to send them $1,000. And likewise, if the market were to go down $10, which it very well could, that would maybe be over a 2-day period. Market goes down $10, now they're going to call and say, hey, I need $5,000. And that's times however many contracts that you've got out there. So if you had 10 contracts, your initial margin would be $25,000. And if the market went down, in our example, you got 10 contracts, the market goes down $10 on 10 contracts, well, now you've got a $50,000 margin call. So you, in that example, you've got to have $75,000 just to cover what you've got in there. And the market can go down a lot faster and stay down a lot longer than what most people have liquidity for. And that's what happens is when it squeezes you and you've got margin calls and you've got to get out and you've got to shed those accounts. So only play, if you're going to play this game, and it somewhat is a little bit of a game, if you're going to play the game, you've got to make sure that whatever your initial margin is, you want to have 3 to 4 times that in maintenance for that contract. I only trade 5 to 10 contracts at a time. Today I only traded 1 contract on feeder cattle. I traded a couple last week. They were small little base hits. I think one of them made $500, the other one made $750. This week made $1,600, and it just so happens that they go up. They go down as well. Don't think that I'm always making money on these. But let me give you an example of why I think that trading futures is the future of the cattle business, and that owning actual cattle is not the way to go, especially if you want to get in the cattle business. Okay, for example, 1 load of cattle. So if I go to the sale barn and I buy 1 load of cattle, 50,000 pounds of feeder cattle, it's going to cost me about $80,000 roughly. We're using round numbers here, but I'm going to spend about $80,000 buying that 1 load of cattle. Now remember, we came up here and we bought 1 load of cattle in the futures contract, and it cost us $2,500 margin. So y'all tie both these together in a minute. 1 load of cattle costs $80,000. If you are working on borrowed money, you've got to have 30% margin or 30% equity in those cattle, or you need about $25,000 cash to purchase that $80,000 load of cattle. And then immediately, once you own those cattle, you've got shrink. So the cattle are off of water, they're off feed, and most of the cattle are going to lose weight during transportation. So they're going to lose anywhere between, say, like 2 to 5%, 3 to 5% over the next 7 days. And then the cattle will get filled back up on water, get filled back up on feed, and you'll get back to where you're at. But you're going to spend the next week losing money immediately when you own those cattle. And where I'm going with that is, let's just say, for example, that in my particular trade, my cattle went up $3.50, I sold the contract, I made $1,600. I didn't have to feed anything over here. There was no shrink, there was no death loss, there was no freight. I didn't have to worry about lining up a truck or anything. All I had to do was buy the contract, hold it for a few days, market happened to go up, I sold it and it made money. Over here, when you own the actual live cattle, you are feed bills, freight, labor, everything from the moment that you own them. So if you've got right here 30% margin on this one load of cattle is $24,000 cash. Basically 10% of your equity, you have the equivalent of owning a feeder cattle contract. And so what if you wanted to come over here and say, okay, well, instead of owning one contract and one load of cattle, maybe I want to own 2 contracts for every one load of cattle. So if the market would only have to go up a couple bucks and you could sell both contracts and do really well. Point being is I can participate on the upside of this market. I can take advantage of all the volatility that's going on in the market, and I have very, very minimal risk in this. I have the right personality to trade these. I understand it very, very well, and when the market goes down, for me, that's a buy signal. When the market goes up, that's a sell signal. I take little base hits and just win after win after win. Little small wins, but you take, say 713, you take, $2,900 that we made on this contract in a week, and you're not going to do that every week, but even if you did it once a month, twice a month, you get into your trading account, you look at the end of the year, and you've made some substantial side money on there, and you haven't risked that much, and you don't have to have any land, you don't have to check any fences. A feeder cattle contract will not die. There is no death loss on a feeder cattle contract. I've gotten some 4-weight cutting bulls out of South Alabama in October, and you want to talk about death loss, it is miserable. I don't ever want to do that again. But for people that want to get in the cattle business, and land is obviously your largest expense, you're not going to go out, especially not going to go around here and pay $20,000 an acre to run cattle on. That's just ridiculous. Young, starting out, you don't have any land, you haven't hustled up enough leases yet, and you want to really, really learn about the cattle, and you want to learn how the market functions, you've got to learn how to trade futures. I don't really trade any options. I understand, buying calls, selling puts, locking in windows, and I understand all that, but a lot of times the premiums that you pay for the right to buy, the right to sell on those options, to me the value on trading those options on feeder cattle is not really worth it. I like actually buying and selling the contracts and owning the contract. Now these are a deliverable item, meaning like if you buy this and you wait until the end of the month or end of the term to when it expires, whoever had the other side of that trade, the sell on there, if you own it and you hold it to the very, very end, you can get delivered on. I think you can pay a $400 or $500 fee on there and not take delivery of the cattle. But feeder cattle, just like lumber and live cattle, and there's probably several other things, corn, I guess, there's several other things that is a deliverable item. So if you were to take out, start trading some of these, and you can trade them on different platforms, just know that you don't want to hold those contracts until the last day, because somebody can deliver those on you. But that is, in short, I'll try to do several of these videos. I like doing them. If there's something that you want to see in particular about feeder cattle, live cattle, corn, those are the 3 that I'm just going to concentrate on. Leave me a comment and I will talk about them. But this is a great, great way for people that want to get in the cattle business, that are young, and you don't have to have a lot of money. I'm talking $2,500, trade one contract. So let's just say that you want to have plenty of money. You want to be able to make your margin calls. Even if you want to buy one load of cattle that's worth $80,000, you still got to have $24,000, $25,000 margin or equity in those cattle before the bank will loan you the money. Let's just say if you could save up $24,000 equity on here, you could buy 10 feeder cattle contracts, or at least have the maintenance, the margin to be able to maintain up to $25,000 worth. You want to have plenty of cash on hand or trade very, very few accounts. You don't want to get squeezed out on margin. You need that Buffett, as he says, the margin of error in there. You want to have plenty of cash to trade it. But this was an actual trade that we made last week. 181 buy. We sold it this morning at 185. Each dollar move in it is $500. So 320 times 500, that's $1,600. It's not a bad trade for a week. But you can see how appealing trading commodities is to hedge funds and lots of places. So I had a $2,500 initial investment, and I had a 16% return. What is that? Over 50, maybe, what is that, 50, 60, almost 60% return on equity in 7 days. I mean, that is, I don't know that you're going to find that anywhere else in stocks or any of the equity markets, any of the bonds, any of that stuff. But equities are very, very volatile, and if you don't have the right mentality, you don't have the right mindset, the right personality to watch that figure go down and have that broker call you and say, hey, we need another $5,000 today or $10,000 or whatever it is, you've got to have the staying power to hang in there and even buy when that thing ticks lower, or just be willing to suffer your losses and go on about it. There's different strategies that you can do. If you're a long-term holder of it and you get a short-term interruption, maybe you want to sell to offset some of your buys, and you can participate in that market going down as you sell it. And then once it gets to a point where you think, okay, well, I'm going to take my money out of the what I sell, the short, and now I'm going to offset it with some buys, and I'm going to buy back at a lower entry price. As long as you got the cash to be able to do it and you understand it, I can simulate some of those trades later. But the biggest thing with this is just having the right mindset and knowing that I really believe that this is the future of the cattle business, is trading futures. It's not going to the sale barn and buying cattle and hoping that they gain weight and you can sell them for more than what you bought them for. I can participate on the upside way, way more than somebody that owns a cattle, and I have way less risk, and a feeder cattle contract has a 0% death loss. And those of you that have got into some wrecks and have been out up all night and early the next day and had sleepless nights doctoring cattle and have gone through bottles and bottles of Draxxin and just been in those terrible wrecks, you can appreciate something like this. I love trading futures, and I'll do several more of these. If you like them, like I said, leave me a comment on something that you might want to see. And this is it. This is a great trade that we made, and we'll go into some more detail on some more trades. It's very, very interesting to me. I love doing it. I like sharing about it. So I appreciate you watching. Thanks so much.